Welcome. A self-managed super fund, an SMSF, gives you unparalleled control over your retirement savings. But that control comes with a price, a long list of annual obligations that you, as trustee, must fulfill to keep the fund complying. Miss them, and the consequences can be severe. In this video, I'll walk you through the essential annual SMSF compliance checklist, the key tasks every trustee must complete, and the deadlines you really cannot miss. I'm from the advisory team at Quantum House Australia, accountants and tax advisors. We'll start with why annual compliance matters so much, then work through the checklist, your financial statements and the annual return, the independent audit, reviewing your investment strategy, the contribution caps and pension payments, and the arm's length rules for related parties. After that, a worked example, a summary of the deadlines you can't miss, the common pitfalls, the key takeaways, and how we can help. Let's start with why this matters so much. The appeal of an SMSF is obvious. You decide how your super is invested, with a level of control you simply don't get in a large fund. But here's the trade-off that trustees sometimes underestimate. With that control comes full responsibility. The fund has to meet a series of annual obligations every single year to maintain its complying status. And the penalties for getting it wrong are not trivial. A fund that breaches the rules can lose its tax concessions, which is the whole reason you're in super in the first place. It can attract significant ATO penalties levied on the trustees personally. And in serious cases, it can be placed under a professional trustee at considerable cost. So this checklist isn't bureaucratic box ticking, it's how you protect the fund. Let's work through the checklist. Item 1. Prepare your annual financial statements. Every SMSF must prepare a statement of financial position, an operating statement, and member benefit statements for each member, and they must be prepared in line with the applicable accounting standards. Now here's a point that trips people up. The fund's assets must be recorded at their market value as at the 30th of June each year. Not what you paid for them, what they're worth now. For listed shares, that's easy, but for property and unlisted assets, it means obtaining current valuations from qualified valuers or using supportable market evidence. You can't just carry last year's number forward and hope. Item 2. Lodge the SMSF annual return. This is a single document that does triple duty. It combines the fund's income tax return, its regulatory return, and its member contribution information all in one. It must be lodged with the ATO by the deadline that applies to your fund. That's the 31st of October if you're lodging yourself, or the relevant date under the tax agent lodgement program if you use one. And don't be casual about the date. Late lodgement results in failure to lodge penalties, and it can trigger a compliance review of the fund. On-time lodgement keeps you off the ATO's radar. Item 3. Arrange an independent audit. This one is non-negotiable. Every SMSF must be audited each and every year by an approved SMSF auditor who is independent of the fund. The auditor does two things. They examine the financial statements to confirm they're accurate and complete, and they check the fund's compliance with the superannuation laws. And here's the sequencing that matters. The audit must be completed before the annual return can be lodged, so the audit isn't the last step. It's a gate you have to pass through first. My strong advice: engage your auditor well in advance. Leaving it to the last minute is how funds end up lodging late. Item 4. Review your investment strategy. Trustees are required to formulate, implement and review the fund's investment strategy at least once a year. The strategy has to genuinely consider the fund's risk profile, the diversity of its investments, its liquidity needs, and whether it should hold insurance for its members. And this is crucial. Simply having an investment strategy sitting in a folder is not enough. It must be genuinely reviewed each year, and that review must be documented. The ATO has specifically taken enforcement action against funds that treated their investment strategy as a set-and-forget document, signed once and never looked at again. A few minutes of genuine review, properly recorded, protects you here. Item 5. Check the contribution rules and caps. Member contributions have to be monitored so they don't exceed the annual caps. For the 2025-2026 year, the concessional, that's pre-tax, contributions cap is $30,000 per member. The non-concessional or after-tax cap is $120,000 per member, with bring-forward provisions available for eligible members. And worth noting for your planning, from the 1st of July 2026, those caps are set to rise to $32,500 and $130,000 respectively. Exceeding a cap triggers excess contributions tax levied on top of the member's marginal tax rate, an expensive mistake. The way to avoid it is to track contributions as they occur through the year, not discover the problem at year-end when it's too late to fix. Item 6. Manage your pension obligations. If any member of the fund is in the pension phase, the fund must make the minimum annual pension payment by the 30th of June. That minimum is calculated as a percentage of the member's account balance as at the 1st of July, and the percentage increases with the member's age. Now, here's why this one matters so much. If you fail to make the minimum pension payment, the fund loses its pension exemption from tax on income and capital gains for the entire income year. Think about that. Income and capital gains that should have been completely tax-free suddenly become taxable, all because a payment was missed. It's a simple thing to get right, and a genuinely costly thing to get wrong. Item 7. Ensure related party transactions are at arm's length. Any transaction between your SMSF and a related party, and that includes loans to members, acquiring assets from members, and leasing fund-owned property to a related business, must be conducted on strictly arm's-length terms. In other words, on the same terms you'd offer a complete stranger. The ATO actively reviews related party transactions because they're a common avenue for getting value out of super inappropriately. And the consequence is sharp. Arrangements that don't meet the arm's-length requirement can produce what's called non-arm's-length income, which is taxed at the top marginal rate. So if your fund deals with anyone connected to it, those dealings need to be squeaky clean and properly documented. Let me bring this to life with a short, hypothetical example. Meet the trustees of the Tan Family Super Fund, a husband and wife who set up their SMSF for the control it gave them and largely ran it themselves. Two issues had quietly built up. First, Mr. Tan had moved into the pension phase, but with everything left until the accountant's once-a-year visit, the fund was on track to miss its minimum pension payment before the 30th of June, which, as we just discussed, would have stripped the fund of its pension tax exemption for the entire year, making income and capital gains taxable that should have been tax-free. Second, the fund's investment strategy was the very same document they'd signed at setup 5 years earlier, never reviewed. Exactly the set-and-forget approach the ATO has acted on. The good news is that proactive administration caught both in time. The minimum pension payment was calculated and paid with weeks to spare, preserving the exemption, and the investment strategy was properly reviewed and documented for the year. Neither was a difficult fix, but both were only fixable because someone was watching the fund through the year, not just at lodgement. And that's really the lesson. With an SMSF, compliance is a year-round discipline, not an annual scramble. Illustrative, of course, but a very familiar pattern. Let me pull the key deadlines together, because timing is everything with an SMSF. By the 30th of June, you need to have made any minimum pension payments, and your assets need to be valued at market value as at that date. Before you can lodge, your independent audit must be completed. Your SMSF annual return is due by the 31st of October if you're self-lodging, or the relevant date under your tax agent's program. And running right through the year, you should be tracking contributions against the caps and reviewing and documenting your investment strategy. Diarise the fixed dates and treat the year-round tasks as ongoing. That combination keeps a fund comfortably compliant. A few pitfalls to watch, because these are the ones that catch trustees out. The first is the set-and-forget investment strategy, a documented ATO focus area, and entirely avoidable with a genuine annual review. The second is missing the minimum pension payment, which, as we've seen, voids the pension tax exemption for the whole year. The third is exceeding the contribution caps, usually because contributions weren't tracked as they went in. And the fourth is non-arm's length related party dealings, which produce income taxed at the top marginal rate. Every one of these is avoidable, but only if the fund is managed actively, with someone keeping an eye on it throughout the year. So to bring it together, the control of an SMSF comes with serious annual obligations. You need financial statements at market value, an independent audit, and then the annual return lodged on time. You must review and document your investment strategy every year. Track contributions against the caps as they happen. Pay the minimum pension by the 30th of June, or you lose the exemption. And keep every related party dealing strictly arm's length. Get those right, consistently, and your fund stays complying, and keeps the tax concessions that make it worthwhile. This is where Quantum House Australia comes in. We provide specialist SMSF accounting and administration, making sure your fund meets all of its annual compliance obligations. In practice, that means we prepare your financial statements, we coordinate your independent audit, we lodge your annual return, and we review your investment strategy and your contribution positions throughout the year, not just at lodgement time. And if your fund ever faces an ATO compliance concern, a non-arm's length income question, or a penalty, we can draw on our colleagues at Australian tax experts, tax advisors and lawyers to handle the dispute alongside the accounting in one place. With an SMSF, that combination of careful administration and specialist backup is genuinely valuable. So, here's the question to leave you with. Is your SMSF genuinely on top of every one of these obligations, or are some of them quietly drifting? If you're not certain, that uncertainty is worth resolving before the ATO does it for you. Quantum House Australia provides specialist SMSF administration that keeps your fund compliant all year round. Visit quantumhouse.com.au or call our Sydney office on 1300 809 697. Thanks for watching. Quantum House Australia, accountants and tax advisors, setting a new standard.